Good afternoon and welcome to Prince George's Community Federal Credit Union's 2016 Lunch and Learn Series. Today's presentation is brought to you with a partnership um, with Coffee, nationwide financial coaching and education center focusing in improving financial health of individuals. As the premier credit union of Prince George's County, we have joined with Coffee to expand our mission, providing quality financial education to our community and lending insights into credit management, homeownership, and money management. Prince George's Community Federal Credit Union is a full-service financial institution serving anyone who lives, works, or worships in Prince George's County, Maryland. We are one of the county's best kept secret with competitive loan and savings rates, as well as discounts to national retailers. We currently serve over 15,000 members in the area and welcome you to come and experience the benefits of membership as well. Later on in the presentation, we will display our contact information, and you may also ask any questions that you may have concerning your financial needs by simply replying to this email. We'll be offering a 60-minute free financial coaching session with the completion of 3 webinars as we actually do more webinars in the future. Today we're going to cover the following topics. We are going to talk about how to begin the process of creating a financial plan, learning how to successfully manage money by providing money management techniques that can put you in control of your financial situation and help you plan for the future. We are going to explore what are the advantages and disadvantages of credit, different types of credit, as well as the techniques on how to improve your credit position. And finally, we'll share some tips on how to plan for your successful financial future. So we should start with a simple question. What is a goal? Goal setting is a powerful process of thinking about your ideal future. It is important for motivating yourself to turn your vision of the future into reality. Whether it's financial, personal, or professional, we should start thinking about how to create your very own goals. So where do we start? Well, these are the 5 rules to set yourself up for success. Rule number 1, always set goals that motivate you. Remember that you are, these are your personal goals. They have to make sense to you. You know, when we're thinking about having SMART goals, we're going to talk about what that format is and on the following slide. Well, I always advise my clients to write down your goals. Go through the process of sitting down, talking to somebody or doing it on your own, but make sure that you actually writing down, you put them in writing. Always have to create an action plan. How do we go from where we are today to where we're going? And of course, there's a process to it, so you have to stick with it. When we're talking about thinking about financial goals and SMART goals, I like to use the SMART process, and this may be familiar to some of you because it is used for a number of programs. When we're looking into the format, it's very simple. We always think about being specific, measurable, attainable, relevant, and time-bound. So when we're thinking about being specific, I always think about giving your goals titles. You know, when we're thinking about financial goals, we're thinking about savings, so we're talking about creating accounts for the holidays, college, retirement, you know, what is short-term, what is long-term, and it's something that must be measurable. Whether it's time, money, you got to give it a sense of scale. When we think about the A, it's always for attainable or achievable. Can we realistically achieve these goals? For R, it's relevant. This is something that makes sense to me. And of course, always got to put a timestamp to it. That's the way I kind of look at it. Difference between a goal and a dream is when thinking about a goal, you put a timestamp to it. They must have a beginning, and there must be an end. So when we're thinking about creating financial goals, what comes to mind? As a financial coach, we encounter all kinds of situations. But here's a glimpse of what the majority of the action plans that we assist our clients with. First and utmost, I always advise my clients to set up for an emergency fund. Most financial planners advise savings from 3 to 6 months salary. The more, the better. Um, and you got to keep in mind, an unexpected trip to emergency room or car repair can easily set you back thousands of dollars. It is also an era of job insecurity. So a job loss can be devastating. Um, so saving money away in a convenient place, um, savings accounts is something that will soften out the blow. If necessary, will give you a little cushion. Um, we always create a lot of plans when we're looking into medium-term goals. Um, work with clients who actually pay down the debt. Even if it's difficult, it will pay off for you more and faster the faster you pay. Um, so when we're looking into paying down accounts, we always advise clients to actually make a list of all the accounts that they may be having difficulties with. Um, Balances, names, annual percentage rates, balances. And the one thing that I do advise my clients is actually to pay the ones with the high interest rates first. If you have a lump sum and you want to pay off an account that you cannot completely pay off, make sure that you contact the creditor to make sure that this is going to be applied to the principal. About to pay more than the minimum on credit cards. Um, and that's something that we are going to talk a little more in the coming up, as you got to keep in mind that will help you improve your credit position. With some clients, we actually, when we're creating an action plan, we advise them to create multiple sources of income. And I don't mean getting involved in a multi-level marketing scheme. If you have a steady job, find a way to turn that knowledge into other streams of income. Sell your unwanted possessions on eBay. But you got to keep in mind that when you're looking into a second job or other sources of income, that you stay on top and you take care of your primary employer. Um, we also work out with clients a lot when we talk about taking care of savings and wrapping up the savings. Uh, that is something that we should be looking into. Once an emergency fund has been created, as being maintained, and your debt is within in control, wrap up the savings is something that we should be considered. Um, but one of the things to consider is that there is a difference between savings long term and an emergency fund, which is funds that you can always borrow money from. So when we're looking into the long term savings plan, there's a lot of different options that we can look into. Keep in mind that your employer matches retirement contributions. You want to make sure that you're not leaving any money on the table. Get that free money. Um, Check with your bank or credit union, see if they offer free financial planning. Most of the organizations, financial institutions, offer that service for free. And they can make recommendations according to what your financial goals are: short term, medium term, long term. And then set up for automatically deductions so you can keep track of that resolution. Refer back to the S.M.A.R.T process. Make sure that the plan that you're putting into action is going to meet your needs. And of course, when we're looking into the fifth option or action plans, we work with our clients to really look into the budgeting and spending pattern to find out where is it that we need to put some focus on it and spend less. Because when it goes down to it, it's a popular resolution, but it is too vague. So when you go through the statements and your books, we're realistic, where is our money going? Start making an action plan and a playbook so you can actually meet your goals. So when we're looking into a spending plan process, it is important to have an idea of how do we water our plants and how do we actually make the tree grow, because when it goes down to it, it is a circle. I always advise my clients, to write down your financial goals first. And you can always refer back to the S.M.A.R.T process, but you have to know what is it that you're shooting for. Track your expenses. At first, it's very important when we begin the process. At least for the first 30 days, you want to make sure that you know where your money is going. We're going to be a little more specific as we move forward. But from there, we actually go into a third step, which is finding out what your monthly income is. Record your fixed and flexible expenses. That is going to help you make the determination if you are living within your means. And of course, it is a circle, so you got to stay on track. It's part of the process. And when it goes down to, the first step, the very first thing when we're looking into tracking your expenses, especially for those first 30 days, every time you put money in the car for gas, you pay the lawn, you rent a movie, anything. If you keep this in mind, if you spend $7 a day on snacks, food, coffee, it adds up. It adds up pretty quickly, and we're looking at about $2,500 for the year. So that cup of coffee that you're having in Starbucks every day, um, it could be something that could be pretty costly. Um, so how do we get started with the plan? In other words, what is the first thing that we need to figure out when we're looking into budgeting and money management? Well, on the first step, we'll talk about um, really tracking all the sources of income. In this particular scenario, we're going to do an example. Primary source of income is $1,500. Secondary source of income is $1,200. And if there's any other type of incomes, we need to make sure that we know what the sources of income for the month will be. Um, so now that we have a solid view on what the income is like, the next step will be to take a look at where the money is actually going. What are your expenses on a monthly basis? And when we think about this, I mean, what do you think that we spend most of our money in the income? Is it on food, healthcare? Would it be insurance, transportation? Where is it that our money is going? And when we're looking into, according to the recent study, and this study is from the Bureau of Labor Statistics, completed in 2014, we can take a look at the average consumer expenditures in America. And when we're looking into the biggest expense normally is on housing. So we can actually, as we are creating a budget as we move forward, you want to make sure that you compare yourself where you are to where is it that you want to be. 33% is very common. The higher that we get away from these numbers, the, uh, the more strenuous the financial situation gets. When we look at transportation, 17%. We look into food at 12%. Personal insurance, 10%. And I mean, when we look into these numbers, you will see that most of us are around that number. Um, when I work with a client that is having housing issues and going through the numbers, and half of the monthly income is being allocated just on the housing expense, we already know that that's really what we really have to put a lot of effort into creating an action plan that will help the client level that situation. So when we're looking into the expenses, there's three different types of expenses. We're looking into expenses that are flexible, fixed, or discretionary. Fixed expenses are the ones that are easier to budget for because the expense is normally always the same. When I'm working with a client and I'm doing financial coaching, I think about it as your four walls. Four things that you have to take care of pretty much every month. Shelter, transportation, food and clothing, and medications, but only some of those expenses are fixed. They're always the same. Um, so when we're looking into creating a financial plan, these are the things that we have to take care of and how much they are, and we can plan accordingly. When talking about flexible expenses, some of them may be flexible depending on the service, but these are the ones that you control the amount of money that you spend. Um, Sometimes flexible expenses are items that you need, like groceries, but you can control how much you spend on them by choosing less expensive items or using a different type of service. And then, of course, discretionary. And these are the other expenses that are not listed on the previous two categories. These are items that are not necessarily necessary to live, but items from which it's easier to eliminate or cut back. And this is just wanted to make sure that we did a quick scenario. Because once we get to this point, then all we have to do is compound your income and expenses, and basically all we have to do is the math. Total up all your expenses from the three categories we discussed, and you subtract it from your total income. Now, there's a lot of tools out there as far as ways that you can do this. Some people like paper. Some people like to do it electronically. I've seen some very complex spreadsheets that people use. You have to choose one that is going to work for you. When you're looking into the collateral that will be made available to you, um, it gives you a sample, and you are going to have access to some of those tools electronically as we move forward. You can use them, you can print them, um, use something that is going to work for you. Because at the end of the day, this is going to be your budget. This is going to be your financial plan. Some people like to go through this process and really break down, what are they going to cover with the first check. If they get paid biweekly, they get paid monthly, they will do it all on once. But in this particular case, when we look at the total income and total expenses, we happen to be a little bit short, $49. Well, is this when we think about the numbers and we actually are looking into this example, this is pretty real. When you compare these expenses, compare it to yourself and see how awful they are. But when we're looking into, once we get to this point, we are going to make a determination. Where are we? Are we in the black or are we in the red? Is your expense greater um, than the total income? So at that point, basically, you could decide what steps to take to reduce your monthly expenses, or to earn additional income, or prioritize your money. Think about what will possibly affect your life in the next few years. You know, when keep track of your expenses. When it goes down to it, you have to know, where do we find ourselves. $49 short one particular month is not the end of the world, but it does make a difference if this is the way that we live our lives. Have to make a determination. What side are we going to be in? Because at the end of the day, savings is the key to success. Keep in mind that if you strive to put away funds into savings, how you want to manage your income. I mean, numbers don't lie. If you start with $100, and you do that every month for a year, and it's only earning 2%, you can't. That builds up. And when you're looking into the different products that are available to your Prince George's Community Federal Credit Union, they do have a lot of options available, not only for yourself, but for those of you that are parents. What kind of options do we have available for accounts that perhaps we want to create for our children? Um, whether it's, accounts that are for ages of 12 or under. They have the teen time, which is ages 13 to 17, or the flying solo from 18 to 25. Um, I really, really like what they have, what the type of accounts that they have, the part of gold account. Because when it goes down to it, I do it myself. If anybody, if you really paid attention to the exercise we just did, I don't know if you noticed, but we have we I didn't put savings anywhere on the budgeting form. Does that mean that I don't save? Absolutely not. The contrary. I use a format of what is known as pay yourself first. So I happen to work for an employer that allows me to split my direct deposit, and I have an amount of money that goes directly to the credit union. And once it goes into the credit union, some of the funds are allocated for my holiday account. Another one, another portion of those funds goes into my daughter's college fund, and another part goes into my holiday account. By paying myself first, I make sure that those accounts are being fed in a monthly basis. Um, but in order to do that, I had to create a budget that makes sense, because I do have to make sure, and I do have to make sure um, that my four walls are being protected, that I'm taking care of shelter, transportation, food and clothing, medications, and so on. Um, and then we begin that process, creating that emergency account first and utmost. Um, if I do run into a situation that I am $49 over on a particular month, I can always borrow money from that particular account and repay it on the following month. So if I'm $49 short this month, I should be $49 over on the following month, and that basically balances me out. Word of advice that we give our clients is, instead of using credit cards, shop with cash whenever possible. And when it goes down to it, they have done studies on the activity that takes place in your brain when you actually um, pay with cash. And when it goes down to it, there is a sense of pain. Even though we don't feel the pain, your brain actually feels the pain when it goes down to making transactions with cash. I mean, really think about it. Once you break a 20, nothing that you can do actually is going to bring it back. Um, when it goes down to paying items that are under $10 when you're eating out, definitely you should be paying that with cash. It's easier to manage. You give yourself some petty cash as far as your financial plan. If you only have one credit card and you use it, plan to pay the charges at the end of the month as you use it and you pay it. We're going to talk about credit in the coming up slides that are coming up. If you cannot control the use of credit cards, of course, you should actually stop using the credit cards. Create an action plan to use them and pay them. But we are going to talk in the second part of this workshop really on how to create and improve your credit position in order to save some money and make the money work for you. So what is next? Where do we go from here? And we have covered quite a bit when we talk about budgeting and savings, which is key. As you create financial plans and you're moving forward, you want to make sure that everything is based on a budget that makes sense, but it makes sense to you. So the first is actually to make a plan. Study shows that having a financial plan gives people a sense of security, which leads to a greater likelihood of financial happiness in the future. The first step is creating a plan and make sure that you can stick to it. Know what your desires are today and what your needs are going to be in the future. When we're looking into second step, we should create and follow a budget. Part of a financial planning is taking a step back and making a list of your income and expenses, as we discussed. You can use a worksheet from today's collateral that will be available to you. But just keep in mind that there's many online tools and smartphone apps that can help you to build your own budget, and they will be accessible to you. We always encourage clients to make sure that they get organized. Keep in mind that the more you work on your finances, the more likely you are to think about your money and ways to make it grow. If you are more organized and engaged, you'll be less stressed. If you frequently pay your bills or track your purchases, the better you stay on top of your money and within your budget. Okay. And when we understand, I mean, it is a circle. So when I look into all these processes, it's an ongoing process. So we advise clients to stay at it. Keep going. When it goes down to budgets, make sure that you choose a budgeting form that you're going to be able to work with, and it's going to be accessible to you. Some people like paper. Some people like to do things electronically. But keep in mind that it will require a little bit of your time, the first few months at least. But it's like everything else. You keep it up and it becomes a habit, and that habit of maintaining a budget will provide a nice payoff for you in the long run. So what is the link? And when we're thinking about credit, how is it that credit can help you to improve your financial situation? So when we're thinking about creating and achieving your financial goals, let's start by taking a minute or so to actually think about what is the first thing that comes to your mind when you think about the word credit. Is it a pleasant thought? Is it a stressful word? I hope it's not credit card. Some people, for me, that I'm always staying on top of it. When I think about credit, automatically I think about what is my credit score. Well, let's look into a definition. Credit is the ability to borrow money. Anytime a bank, finance company, or business lends you money, or you agree to pay it back at a later date if you're using credit. Most cases, there is a charge for borrowing the money, either in the form of interest or both. But here's a bit of credit history for you. Monitoring credit behavior has been around for as long as merchants have extended credit to others. Over time, technology has contributed to the speed at which credit grantors or lenders can make a determination as to whether or not to extend credit to a given individual. But the concept developed in the mid to late 1800s still form of the basis of today's credit decisions. So when we think about credit, there's always an advantage and a disadvantage. Let's talk about the advantages first. So when we think about what are the advantages of using credit or a line of credit, um, well, it gives you the ability to buy or obtain services that you need now, of course, with the promise that you're going to pay it later. But it basically reduces the need to carry cash. We are getting to a point now in 2016 that actually less and less people actually are carrying cash. You know, lines of credit are much more, whether they're electronic, we're looking into debit cards, ATMs, credit cards, lines of credit. There's a lot of different ones. We're going to talk about some in a minute. But it reduces the need to carry cash. For certain individuals, it creates a record of the purchases. In my particular situation, I have a personal credit card that I use pretty much on a daily basis, and I have one that is used for all utilities and all the expenses in the month. Then when I consolidate my bills at the end of the month, I know how much money was spent for one item versus others. You know, what was spent on food, what was spent on gas, utility bills goes into the other accounts, and it basically it's easier to create a record of the purchases. Now, I am able to do that when I create my budget. I do have a petty cash account. So on Mondays, I get the ability to have $20, but it is accounted for. So when it goes down to it, I do have the cash accounts, and then I have the ability to create a record of all the purchases that took place with the credit cards. And it's much more convenient than writing checks. Um, as long as I use them and I pay them at the end of the month, it's basically just one way of managing my accounts. But there's some disadvantages to that as well. When we think about what is the biggest disadvantage to credit, well, there could be a higher cost of the items if there is an interest that occurs. It may require additional fees. Um, if you are having financial difficulties, it's something that you can easily lose track of how much has been spent every month. If you know that you're having issues with the way that you can control your accounts, it could be a dangerous proposition. If we're thinking about types of credit, what types of lines of credit are there out there? Well, we can start with single payment credit. And this is one of the most common lines of credit there is out there. Basically, this is when items or services are paid for in one payment within a stated period of time. And interest is usually not charged. This is where utility companies come in, medical services, some retail services, businesses as well. They fall in that category. And then we have installment credit, and this is when merchandise and services are paid for in two or more regular scheduled payments of a set amount. If there's fees or there's interest, it's normally included. Some retail businesses, such as car and appliance dealers, commercial banks, finance companies, saving loans, and when we're looking into signature loans or lines of credit that may be through a credit union. And this is actually when we think about revolving credit, this is the most common lines of credit out there. So when we're thinking about having a line of credit in which goods and services can be bought using revolving credit for as long as the total amount does not exceed the consumer's credit limit, repayment is made in a regular time. This is the most common lines of credit. This is what credit cards fall into, gas stations, and charge cards such as JCPenney, Macy's, accounts that are being used in a regular basis. Basically, they extend a line of credit according to your credit history, to your FICO score, and other things that we're going to talk about in a minute. And basically, you don't have to pay it all at the end of the month, even though it's advisable. But things that we have to keep in mind, because when we're thinking about revolving credit, what can we do? And when it goes down to the majority of the clients that they contact us, let's be realistic. They're not always having a good day. When we're thinking about the median credit card debt in the USA is just over $8,000. Um, Many people are carrying more debt than others, and they are sinking rather than swimming. And when we're looking into 7 out of 10 low and middle income household reporting using the credit cards as a safety net, relying on the credit cards to pay for car repairs, basic living expenses, medical expenses, and home repairs. So when you're looking into having an issue over the holidays, is that really an emergency? But that's actually, when we're looking to the numbers, 7 out of 10. Um, that's the majority of the phone calls that we take when people are facing um, financial need. 30% of the households reporting using the credit cards to pay for basic expenses, and this is very common as well. So of course, when this takes place, credit card debt skyrockets, and it becomes nearly impossible to keep up. And there's programs out there and things that we can do. Um, but when we're looking into the responsibilities, you have to keep in mind that we can't, we have to get to a point that when you use the credit card, the way I look at the credit card is very simple. It's a short-term, high-risk line of credit or payday loan. Um, you have to avoid buying an impulse. You have to keep in mind that you must borrow only when you can repay. You have to understand the contract and what your responsibilities are. Pay your debt promptly. This is something that is not only common sense, but it's something that does affect your credit relationships with your lenders. We're going to talk about credit score in a minute, and that is actually one of the biggest factors. If you know for a fact that you are not going to be able to meet that responsibility, you need to open the lanes of communication and notify your creditor as quickly as possible. They may be able to help you, and there's programs out there, forbearance programs, on looking into student loans, escape of payment programs, but IPOs, which is an interest payment only option. But the one thing is that you need to make sure that you notify your creditor if you know that you're not going to be able to make those payments. And that, in the same coin, we have to keep in mind uh, to make sure that you guard what you have. If you lose or have your credit cards stolen, you need to report that as quickly as possible to make sure that you minimize any exposure that you may have financially. And we are going to talk a little bit about ID theft and prevention in a minute. But when we're looking into your credit history, it's one of those things that it is kind of like your own reputation. How do we start? Where do we go? Well, start with keeping in mind that it's all about relationships. So when it goes down to what can we do to begin our credit history on the right path, that relationship with your credit union is important because they have a lot of tools and programs that they can help you with, but you have to keep in mind that they look into a lot of different factors. Your work record, how long have you been in your profession, how long have you been at work, how have you been able to handle your bills in the past? Do you have a checking account or relationship with a financial institution, whether it's a credit union or other? So that ability to keep a steady line of work and paying your bills promptly and consistently, having that banking relationship and checking and savings and make those regular deposits will help you get to a point that you can begin to apply for a credit card through a store, or mostly known as charge cards, perhaps apply for a small loan using your savings account as collateral. And these are the things that you can do if you're having difficulties at the very beginning. Some of my younger clients, we advise to use a co-signer, college students, for example. But when it goes down to it, your credit union can help you with that as well. They have a number of programs and accounts that can help you to begin down that path in a way that is and that is going to be in the best interest of the client. Um, but one of the things that is not only I'd like to say to start where you are, but the first step into building a better credit report is actually having an understanding on what is in your report. There are three credit reporting agencies: Equifax, Experian, and TransUnion. You do have a right of obtaining a copy of your credit file, your credit record, once a year. Um, there's a lot of different ways of going about it. You have the ability to go to annualcreditreport.com. You can obtain that free copy either online. If you're not comfortable by doing so, you can always call them at 877-322-8228. You can download the form on annualcreditreport.com if you want to request that the three credit reports to be mailed to you. You can always reach out to a member on your credit union. They can give you some idea on some information on how to do so. But it is important. You have to have an understanding when we think about what does your credit mean, and what is the meaning of credit. You need to know what is being reported, um, because it is something that it will have an impact on the future. Um, so when we think about your credit score, basically a credit score is a number that summarizes the consumer's credit risk. It's a way to measure risk, and it can change due to different factors, and those factors are based on the things that you do and your behaviors. So again, it's a snapshot of a person's credit picture. The higher the score, um, the the better chances that we have um, that you will be approved for a line of credit. Keep in mind, your credit score changes for good and bad over time depending on the history. And there's some factors, and a lot of people don't understand, how the factors are calculated, but it's not a science. Basically, numbers are are this. FICO is the first ISA corporation that actually owns the formula to actually come up with the ratios that come out that gives you your credit score. When you look into your credit score, the largest chunk that makes your credit score is your payment history. 35% of your credit score is based on your payment history. So the one thing that we advise our clients, regardless of what happened in the past, we need to make sure that we focus on making sure that if only the minimum payment is being paid, that we show that consistency. The second factor is 30% is actually what is known as utilization or accounts that are owed. If you consider those two factors, that is 65% of your score. Your payment history and the accounts that you're carrying on your back. And of course, we have other factors as well. 10% is on your credit, 15% is on the length of your credit history, and the types of the combination of credit and use. So when we think about this, those three factors, they're not as impacting, but they are. So when you're looking into having what is healthy credit looks like, or it's a combination of. Um, Payment history is the number one factor. When we're looking into clients that are looking to become homeowners, and they need the credit score to go up in order to qualify for a particular financial instrument, the quickest way to actually improve your credit score is by paying what you owe. Remember, when we're looking into the financial goals and the action plans that we help our clients, number one was to create that emergency account, and then we talk about paying off your debt, paying what you owe, eliminating debt. What is a good number? Well, a credit card or lines of credit are, like I mentioned before, they should be utilized as emergency accounts or such. You use them, you pay them. So we want to make sure that we carry as little as possible. Um, in my mind, the way I look at it, I have my reservations on credit, because when it goes down to it, there is a cost associated with using somebody else's money. So when you are carrying balances from one month to the next, that is 30% of your score. So if we reduce our debt, your credit score will shoot up. When we're looking into factors such as length of history, something that is a slow process. Um, when we talk about new credit, when you open an account, not only does it impact your score because they did a hard pull to look into your score, but there's other factors as well. So when you look at it, this is actually what makes your picture. When we think about your credit score, things that are not included that will not have an impact on your score are things such as race, color, religion, sex, marital status, age, salary, occupation, employer, where do you live. So those are things that will not have an impact on your credit score. But your behaviors on how you handle your finances do. So when we're looking into credit reports, what shows in a credit report? There's 5 information zones. We have what is known as personal information, and this is compiled information from the credit applications. And these are the ones that you have filled out, normally procedures, and includes regular information such as name, current address, recent addresses, social security numbers, date of birth, even previous employers. So that comes out on the personal information. Then we have credit scoring results and summary. So this section contains a summary of all the factors that make up your score, called the reason coding. Um, and when we're looking into an example on those notes, it is important that you have an understanding and you actually go through it to make sure that that information is accurate as it's being reported. So that ties up with the ability to actually obtain a free copy of your credit file, your credit report every year. It's also going to show the trade lines and regulatory accounts. So when we're looking into it, this is the bulk of your credit report, and it's going to show the details about credit accounts that have been opened in your name, and that list of you that you may be as an authorized user or joint accounts. Um, and these account details, which are supplied by the creditor, includes data, the date that the account was opened, the credit limit, the amount of the loan, the payment terms, the balance and history that show whether or not you paid the accounts on time, closed or inactive accounts, and the matter that they were paid. So when it goes down to how long would that information will stay in your credit report, it's also important that you have an understanding, because that could be from 7 to 10 years. When we're thinking about things that affect your score, you got to keep in mind that the 3 credit bureaus also record all the inquiries into your credit. How much credit are you looking for? And that's something that you have to pay attention to as well. For lenders, it's also important to know what is being shown as far as in the public records. In this section in your credit report, you will find information obtained from the government source, such as court of law. They may include bankruptcies, child support, liens, and you got to have an understanding on how long that information may show in your credit report. Remember when I said the biggest factor is your ability to make your payments on time, but when a lender is trying to measure risk, they look into other factors as well. But you got to keep in mind that there is a beginning, there's an end. It can only be reported for a period of time. When we think about bankruptcy filings, civil suits, judgments, records of arrest, liens, taxes, most of this information will only stay in your credit report for 7 years. You got to keep in mind when we're looking into tax liens and judgments, we're talking about 7 years after the account has been taken care of. Okay, and there is a difference on how long what information will be as far as bankruptcy, but that depends on what type of bankruptcy filings that we're looking at. Chapter 7 is elimination of debt. Chapter 13 is restructuring of the debt. That takes 10 years instead of 7. So those are things that we have to keep in mind. I know that we're a little bit on time, so I want to make sure that we do talk about protecting yourself and ID theft cases and protection. because when we're looking into the number of cases in the U.S., it's pretty staggering. I'm pretty sure that you hear it all the time. And when we look into some of the studies that they have done and some of the numbers, it's something that is concerning. Approximately 15 million residents in the U.S. have the IDs, or the identity used for fraudulent accounts, and when we look into the number of losses, we're looking at $50 billion dollars, as in the numbers that they're looking at for 2016. With some of the cases, and this is the most information that most recent when I look into the cases for Maryland. Since 2005, the number of Maryland cases are growing significantly per year. We're looking in prosecuting cases. We have gone from 34 defendants in 16 cases to 134 in 2014. And that's the most recent information that we have. So when we're looking into the costs, we estimated $17.3 billion. And this is something that when you think about it, there's what is being reported and what is not reported. As a coach, as a credit counselor, as a housing counselor, you get a lot of stories that are really not reporting. And why would somebody not report when they have been victims of ID theft or such? Normally, it's when it becomes friendly fraud. And that is something that is very common, usually not reported outside to federal agencies, but those are one of the things that sometimes I had to deal with when I do financial coaching with my clients. Because when it goes down to it, they cannot report it because they refuse to take it to the next level because their children have committed the fraud, or very common when it goes down to college students as well. So it's something that we have to be aware of. But when it goes down to your credit union, Prince George's Credit Union, they use what is known as a SMS, Guardian Alert Service, and this is a free service that comes to you when you use your Visa debit or your credit cards through the credit union. If an unusual transaction should occur, you will receive a text message within minutes asking you to verify the transaction. They basically are doing, some people, sometimes they become a little annoyed that they get too many texts, too many communications, but when it goes down to it, we are looking into protecting the integrity of the information that they have access to, and they want to make sure that they protect your account as well. So when we're looking into wrapping it up and actually, what is the advice that we can actually provide to clients that are looking into improving their credit position, and why is it so important to improve your credit position? The one thing is that we advise our clients constantly is when we look into the credit report and we're giving them advice, is actually to build positive new credit references. The best thing you can do to build up your credit score is to use it carefully. Always pay your bills on time. Those costs, when you think about the consumers that are proactive about rebuilding their credit after the problems have occurred, since they see that improvement, when it goes down to it, it's not an easy fix as we would like it to be, but it's a process to it. So once you understand the process, you'll see and you'll understand how we can improve. And I always think about ways to increasing my income by reducing my expenses. So when it goes down to it, what is it that lenders look into? It is important so you can actually have a better understanding on how you can achieve your financial goals. And part of that should be to improve your credit position. Keep in mind, lenders want to see at least a couple of recent accounts paid on time. My advice to clients is that regardless of what happened in the past, from now on, as we move forward, we need to make sure that all accounts are paid on time, even if it's just a minimum payment. Should we pay more into it? Absolutely. We should use it, use your credit, and pay it all at the end of the month if possible. But if not, we need to make sure we make those payments on time. Carrying balances and paying interest is not necessary for rebuilding good credit. Activity is important, but when it goes down to it, carrying a balance is actually something as we saw when we talk about those factors that actually will have a negative impact. and your credit union can help you with that. If you had credit issues in the past, it's something that you can talk to somebody on the credit union. Um, when it goes down to the types of accounts that they have available, what can they do to help you to build up your credit? And there's many options. Make an appointment if you wanted to see, talk to somebody in the credit union, but they may have the ability to actually offer a secure credit card to begin to build up your credit. If you have too much credit, it's one of those situations that, or too much balances, high balances on your accounts. They be able to actually offer you a consolidation loan that you can combine them all into one payment. It will be easier, not only easier to handle, but easier to pay off as the interest is lower than the credit cards. And they also offer, not only the savings accounts and the high yield accounts, but the mobile banking is actually something that makes it a lot easier. I like to believe I'm a little techie, uh, but when it goes down to it, it's one of those things that keep in mind that they're here to help you. It is something that is available to anybody that lives, work, or worship or volunteer on Prince George's County, Maryland. So when we're looking into using and utilizing the resources that are available to you, we hope that you take advantage of this. With this, I'm actually will be ending our presentation today. This is actually one of the longest workshops that we do. We hope that you have found the information useful. You can always reply to the emails. Any questions? All this information is kept confidential. So basically we can um, answer any questions or point you in the right direction for any financial need that you may have. Once again, thank you for attending our Lunch and Learn, and hope that you hear from us soon.